think we have a quorum. So happy New Year, everybody. This might be, either the last or close to the last official day where I can wish people a happy New Year. So I hope everybody had a great holiday. I know my year has started off pretty fast. And as always, there's a lot going on in the market, and I think we'll have a lot to talk about as we sort of digest where 2024 has been and where we're headed. So with that, Ryan, if you don't mind paging forward, you will see our handy disclosure slide, and just a reminder of some upcoming events. In addition to this quarterly outlook, we are continuing to do one just for clients. And so in your Kim newsletter, if you're interested in inviting clients, there is a compliance approved invitation that you can use to invite clients to it. It'll be the same material, but a little bit more client friendly. Folks are able to get on there and actually ask live questions. We've gotten feedback from a lot of you where you've been able to use that as a nice client engagement tool. So just know that that's available. Next week, we will also have the continuation of our monthly thought leadership webinar. Next week is going to be to alt or not to alt. You are probably aware that Kestra Financial has rolled out its partnership with iCapital, which is a really handy solution if you're looking for alternatives for your clients. So Anastasia Amorosa is the Chief Investment Strategist at iCapital. So she'll be joining us for a conversation about what they're seeing both in public markets, and then she'll talk about what they're seeing in private markets as well. There too, you're welcome to join the chat and ask live questions. And of course, don't forget that we have our very exciting Ascend conference the first week in February. That will be here in Austin. So we are knee deep and planning for that. We have a lot of different sessions that are going to be coming up and part of the event. The Complete Wealth Manager will be a panel with myself, John Amore, Chad Jurvenga, who's part of our new insurance solution, and then Doug from Arden, our trust solution. Then we'll be celebrating Kim's 3-year birthday and talking about portfolio construction. We'll have a session with Capital Group to talk about the Capital Group focused portfolios that we're running. We'll have the L2 team talking about our active equity series. You'll hear more about how they've done in 2024 from Derek as part of this session. On the Road Again is the name of my main stage session. And then finally, we'll have Diversification 2.0. That will be a session with Dimensional to talk about the Factor Tilt series of portfolios. So a lot going on. As I said, we've started off the year very, very busy, but all great stuff. So with that, why don't we just take a quick peek at what happened in the markets over the last year. So you'll see here, I mean, one thing that always stands out to me looking at this is that every one of those bars is in positive territory. And if you remember back to 2023, that was also a year when pretty much every one of the bars was in positive territory. And you're probably already well aware of this, but all the way over on the left, large cap US stocks up 25%, a really remarkable return, and on the heels of a 20+% return in 2023. So back to back, very, very strong years. And as much as there's been hand-wringing about fixed income, you'll see that those are positive numbers. US aggregate up just over 1%, so disappointing return, but still in positive territory. When we dig into sector performance within the S&P 500, here too, you'll see almost universal positive performance. The best performers continue to be in communication services and technology. Again, a continuation of what we saw in 2023. But we saw things like financials really start to take off for the first time on the idea of having a more normalized yield curve. And interesting, utilities had some really strong performance during the year after middling performance previously, helped by lower yields on the fixed income side. So definitely some interesting stories. Within there too, we saw massive divergence between growth and value. And again, this is a continuation of the story in 2023. But over those 2 years, it's pretty remarkable. Russell 3000 growth gaining 87% over 2 years versus value at 27% in 2 years. Now, let's not forget that 27%, even over a 2-year period, is a really good number, but doesn't look so great when you compare it to 87%. So just massive divergence between those two areas of the market. Over on the Treasury side, again, some really interesting changes. If you recall, we started the year with expectations at one point of 7 rate cuts in calendar year 2024. We ended up getting, what, like 2, 3, barely. So the Fed was much slower to cut rates than what the market had expected. And in addition to that slow pace of cutting rates, we also saw higher long-term rates. So that's the proverbial twist in the Treasury yield curve. And interestingly, if we look at the next chart, you'll see that much of that twist really happened just after the Fed started cutting interest rates. So that dark line there is the Treasury yield curve as of the end of 2024. The gold one is the day the Fed cut interest rates first. And so it's a good reminder that just because the Fed is cutting short-term interest rates doesn't mean that long-term interest rates can't rise. And so what that means is that some folks who rely on long-term financing, think homeowners with mortgages, they don't benefit from those lower short-term rates. And you can see on the right some of the nominal changes in yields across the curve since that Fed rate cut. Very different experiences depending on where you are. So with that, let's take a look at what is happening in the economy. So this is our dashboard, just meant to give a quick overview about where we are in some of the main areas of the economy. And I'll just highlight in all 5 of those areas, we're about in the middle, right? There's no area that is really strongly in the green, no area really strongly in the red. Now, they have moved around a little bit, but not really significantly so. I'll point out monetary policy, which is now in the green. We've kept it modestly in the green simply because that pace of Fed cutting has been slower than expected. And then I'll mention housing, which is over there towards the red. So with those higher mortgage rates, seeing less activity in the housing market, though again, home prices have really held in fairly well. So let's talk a little bit more about the Fed and inflation. And if you follow our work here, this is going to look familiar in that, we've been thinking for a while that even though the Fed has said that they're targeting a 2% inflation rate, it's going to be really hard to get there. If you look at the average inflation rate going back to 1990, it's run, a good bit higher than that at 2.5%. We just got a CPI print earlier this week, so we're running in the low 3%, depending on how you measure it. So still a good bit above where the Fed would like to be. And so that will, again, kind of slow the Fed's pace of being able to cut interest rates. At the same time, we don't think 2.5% is a bad rate. Obviously, the economy has lived with that level for a very long time. Prior to the 1990s, we lived at a much higher interest rate than that. But so at some point, I think the Fed will probably have to capitulate and accept a somewhat higher inflation rate. And the reason why they have to be really careful is because there is a possibility of a resurgence in inflation. It's not our base case, but it is what we saw in the 1970s and 80s, where it seemed like the Fed had really licked inflation. CPI came down quite significantly, and then lo and behold, over the next couple of years, actually made a new high. Now, there were structural reasons why that happened. And again, this is not our base case, but this is in the back of Fed policymakers' mind, sort of keeping them from being too aggressive in cutting rates. It's easier to go later and cut rates than it is to raise them back up again if you've made a policy mistake. With that, the market has been sort of like back and forth in estimating where the Fed is going to be. In December 2024, markets were predicting that the Fed funds rate would be at, in December 24, the Fed funds rate was 4.3%. Right now, markets are forecasting that by December 2025, it'll only decrease modestly. Now, this was a week ago. Over the last couple of years, last couple of days, the market's gotten a little bit more excited about what the Fed might be able to do. But safe to say, right now, market has pretty modest expectations for how much the Fed is going to cut going into next year. With that, another piece of that cautionary tale, just showing that long-term rates kind of move at their own pace. The Fed is controlling the overnight rate. The 10-year Treasury yield tends to be more coincident with the expectation of economic growth and inflation. And so here you'll see that September Fed rate cut in September led to 10-year Treasury yields rising pretty consistently through the end of the year, despite additional cuts and, again, political changes and whatnot. And that drove mortgage rates up. We think that, again, over the last couple of days with some more modest CPI numbers, that yield is coming down a little bit, but it is not a sure thing that long rate is going to come down. Because inflation expectations have remained quite sticky. So in the meantime, when we look at different areas of the economy, it still is sort of a tale of two cities a bit. That gold line, again, if you followed this, you're familiar with these charts. That gold line is the services index, and you can see a really nice acceleration through the second half of 2023. The blue line is manufacturing, which has essentially been in decline for 2 years. There have been moments where it seemed like it was crossing over into positive territory, and then it's dipped back down again. We're getting close to neutral again, but safe to say manufacturing remains in a lull and is not much of a contributor to overall economic growth. Consumers, on the other hand, have continued to spend. In fact, we had holiday sales come out, or December retail sales come out today that reflected holiday shopping that looked quite positive. And you'll see this is on a real basis. So overall sales, but then taking out inflation, and you'll see a really nice kind of recovery throughout 2023. So consumers are telling us that they're very comfortable spending. Now, when you ask them how they feel, they give a different answer. So if we look at consumer sentiment, you'll see that red line shows the average level of consumer sentiment during recessions. And we remain pretty close to where consumers have typically been in recessionary periods. Again, improving from where it was in 2022-ish, but still very low given the really strong level of economic growth. And I think the reason for that disconnect is because of the lingering impacts of inflation. So over time, as consumers get more used to new price levels and inflation continues to abate, I would expect this number to improve, all else equal, but it does take time. And the labor market's a really big part of that as well. And so this is, again, many different ways of measuring this. This is just the overall unemployment rate. And you can see unemployment rate ticking up. So a good bit higher than the lows that we experienced in the sort of late COVID world, but still really, really low compared to a very long history. So still really healthy labor market, though, will likely continue to soften. So in small business surveys, company owners are saying that they have lower expectations of hiring going forward. But again, if you compare it to a pre-COVID level, they still look fairly healthy. So with that, overall strong economy, continued growth, strong momentum, some red flags out there, largely in the labor market, but overall, that's a pretty good environment for stocks and bonds. So if we page forward to there, you'll see 2024 was one high after another, where I think CNBC got a little tired of continuing to count how many new highs were made in 2024, but not a terrible place to be if you own stocks. And what's really incredible is that this stock performance happened during a time when there were tons of really negative headlines. I mean, we just have a sampling here, but think about it, second year of a Russia-Ukraine war, more conflicts in the Middle East. You had an assassination attempt. You had a contender for the presidential election drop out very late in the process, the unwinding of the yen carry trade, and of course, election, which we spent much of the year focused on, and then the fall of the Assad regime in Syria. So, if you saw that collection of headlines, you would think that the market would have a hard time rising in the face of that. But sure enough, not only did it rise, but we put up more than 20% of a return in the S&P 500. So great example of, this sort of mantra I learned very early in my career, and that markets climb a wall of worry. So there was plenty of worrying over the last year, but there was also plenty of climbing. Now, you are well aware by now, I'm sure, that much of this strength has come because of the Magnificent Seven. And we've had some version of this chart for 2 years now, sort of showing how this handful of 7 names, which also happen to be 7 of the largest stocks in the S&P 500, have just really dominated returns. But if you look at that gold line, again, that's the S&P 500, pretty positive returns. And that green line, also like a decent return for small caps, but doesn't feel that great when you compare it to 160% up by the Magnificent Seven. What's interesting is that, and Derek will talk about this some more as we get into some of the model performance. I mentioned that the markets have gone, made new highs throughout the year. And if you look at the dark line here, so this is the Russell 3000 rolling day volatility. When you compare that to historical, which is the green dotted line, volatility overall has been lower than average, which is particularly surprising because it was an election year, and typically election years have much higher than average volatility. So it's, again, pretty remarkable. You look at the headlines, you think about the fact that it was an election year, stocks bounced around less than they typically do. But then when you look at bonds, it was actually the opposite story. So note that the y-axes for these two series are different. But bonds relative to their own historical volatility have had very, very high volatility. And you see that peak back in 2023 with a level of volatility that we've really never seen in the bond market, at least in modern financial history. It has started to come down, but is still well above average. So, excuse me, when you put bond volatility right alongside stock volatility, typically stock volatility is much, much higher than bond volatility, right? But relative to average, stock volatility is lower, bond volatility is higher. So bond volatility is still lower than stocks overall, but it's much higher than it typically has. Now, so what does that mean in terms of going forward? Often periods of high volatility are actually buying opportunities. And so we think, particularly as that volatility starts to come down, you have higher yields that are available in fixed income. This is actually a nice kind of medium-term entry point for a lot of fixed income investors. But before we get more into fixed income, let's take another look at the S&P 500. And again, thinking about how long is this going to continue with the Mag 7? Now, it's very hard to determine turning points, right? When is the market going to start to shift? But a reminder about what has happened over the long term in the S&P 500. So on the left, we're looking at the period of 1995 to current, so about 30 years. The blue bar is showing you market cap weighted index. So that's the straight up S&P 500, up 12% a year. Again, great returns. On an equal weighted basis, so if you owned all 500 of those stocks in equal amounts, you would have earned over 12%. So that's pretty good. You would have picked up 50 basis points per year over 30 years. Over 30 years, that's a meaningful improvement. For just the last 2 years, though, from 23 to 24, the market cap weighted earned, and this is over that total period, the market cap weighted earned 58% versus equal weighted at 29%, right? So you have the average is one way and the last 2 years experience is very different. So again, it's just a reminder that typically it's smaller cap stocks that have the higher performance over time. And in fact, over a 30-year period, even with the extraordinary outperformance of the Mag 7, the equal weighted still shows a better performance over that 30-year period. So, at some point as we get into what I would call like more normal market conditions, I think there's an opportunity for some of these smaller names to start to take the lead. And one way that can happen is through earnings. So we've talked in the past about how the Mag 7 over the last 2 years have been able to grow partly because of their incredible earnings power. And so you'll see that blue bar there, I mean, just up in stratospheric levels in late 23 and 24. So really, really strong earnings growth. That's a big difference between today and say the 2000 period when you had companies that were trading on eyeballs and vapors. There's real solid earnings power. But looking forward, so that gold bar is everything else in the S&P 500. We take out the Mag 7 and then add up the earnings power of the remaining part of the index. And what you'll see there is that into 2025, the S&P X Mag 7 really starts to catch up with the Mag 7. So that by the fourth quarter of 2025, we have Mag 7 and non-Mag 7 getting closer and closer together. Now, that's also at a time when valuations are very different. So as we look at S&P 500 valuations overall, you'll see S&P in aggregate trading at about 22 times. That's much higher than our average, about 16 times. But if you take out the Mag 7, the Mag 7 is really driving a lot of that higher valuation. The rest of the S&P X the Mag 7, it's not quite at 16. I think it's like 18, 19, or long-term average 20. So it's still not cheap, but much cheaper relative to how the Mag 7 are being priced. So as you think about it, Mag 7, strong earnings growth, high valuations. The rest of the market, slower earnings growth, lower valuations. But as that earnings growth catches up and you have the lower valuations, that's a lot more appreciation opportunity among all of these smaller names. Again, what will change that? It is anybody's guess, but the ground is fertile, shall we say, for those names to really see some nice appreciation going forward. And you don't necessarily have to have the Mag 7 that turned down during that time period. You just need to have them slow down and kind of leave room for the rest of those names. So quick peek at the fixed income side. We talked a little bit about what's happening in treasury yields. On the credit side, you'll see on the left bankruptcy filings by year. And you'll note that 2024 bankruptcy filings are the highest that we've seen since 2010. Now, you can tell that they're not soaring. They're higher than what we've had in the recent past, but not egregious levels. But it is worth noting that we're seeing a little bit more stress in the corporate side. And meanwhile, on the right side, you'll see high yield spreads, which miraculously just continue to tighten. So those spreads do not reflect what we see as a higher level of bankruptcies on the left. So a lot of times when we look at how much you're being paid on the high yield side to take that additional credit risk, it's not always as worth it as it might have been in the past. A couple notes on the election, because we've gotten a lot of questions about this. We thought this was interesting to kind of highlight the impact of the election on markets themselves. So one of the big things that the Trump administration or the incoming administration has been focused on is tariffs. And on the left side, you can see how some different industry groups have reacted to this anticipation of tariffs. So you have semiconductors, which are largely manufactured outside the US. And with a blanket tariff, they would be subject to that. So costs would go up for anybody who's buying semiconductors. Meanwhile, software is largely built in the US and so would be exempt from tariffs. So you'll see on election day, those two started to move in different directions where semis came down and software came up. Now, interestingly, more recently, they've started to go their own way again. So there was a relatively short period of time where we saw that election impact, and then it kind of started to abate later in the year. Similarly, on the right, you'll see the red line is a basket of stocks that are expected to benefit from a Republican administration. blue is a basket expected to benefit from a Democratic administration. So you'll see in the run up to the election, those two were sort of like trading places depending on where the polls were. Election night hits, it's clear who's winning, Republican names take off, but then you'll see over the last couple of weeks of the year, both of those stocks start to converge again. And they're not completely converged, but what we've seen in other cycles is that that election effect is pretty transitory and starts to work itself off. One interesting note here is on the Bitcoin side, which, okay, number one, it's a very, very volatile asset class. So you would expect it to move around a lot more than some of these other assets. But what you do see there is a very pronounced rally after election day, and it's been able to hang on to a lot of those gains. And that is one area where you could argue there are potentially some big regulatory shifts that are coming up going forward. And so there's, you know, a real fundamental kind of underpinning for that run. Another big question I get is on tax cuts and thinking about the implications there. If you remember the tax cuts that were enacted in the first Trump administration or expire in 2025. So the expectation in a new Trump administration is that they'll largely be extended as is. Maybe they'll be chipped away at a little bit. But here, this shows the impact on the deficit where we're looking at those dark blue bars are assuming that the tax cuts expire. And so you'll see how, you know, the deficit continues to increase over the next, 8 years or so. But then with the incremental deficit from the tax cuts being extended, you have an additional, couple hundred basis points that get added to the deficit going forward. So this has begun to get more attention as people are thinking about, these longer term issues that the government is faced with. And so expect there to be more conversation about this. I've talked a lot, so I'm just going to end on, one of my favorite charts from our friend, Professor Jeremy Siegel, Stocks for the Long Run. Just a reminder that, we talk a lot about what's happening over the next quarter or year or whatever, and there's a lot of hand-wringing about volatility in stocks and the markets. But the fact is, stocks remain an incredibly reliable way to build wealth over the long run, and are a great way to be able to get your clients to where their financial goals are. So with that, I'm going to take a deep breath and I'm going to hand it over to Derek to dig into performance on our model portfolios. And as we do that, I will also remind everybody there is a chat box at the bottom of the screen, and please feel free to go in there, ask questions. I know some of you have emailed questions to us, and I will take this one quick one that got put in, but the question is, will a copy of this PowerPoint presentation be sent out? And the answer is yes. I believe it's already in your inbox. If you go to the Kim newsletter that got sent out late Tuesday, there should be a link there that takes you to a client-approved version of this deck. So with that, Derek, the floor is yours.
Thank you, Kara. So the transition here is from exciting to a little bit less exciting, given there's a lot of data in here, but I'll do my best to make it as interesting and engaging as possible. And my hope is you'll have a bunch of questions as I walk through this that you can feel free to throw into the chat. So just to remind you all, this is the model lineup that we have right now, and this is expanded from where we were 6 months ago and a year ago. So we're now up to 55 models. I actually think there's a pretty easy way to think of this. We have 4 series models, we have satellite models, and then we have the active equity separate accounts. So if you're trying to do a full asset allocation solution, it's really those first 4 lines there. The core series are strategic, dynamic, strategic tax aware, and dynamic tax aware. Those are coming up on 3-year birthday at the end of the first quarter of this year. So we'll have a 3-year record actually in less than 2.5 months, which we're really excited about. The satellite models and some of the core models started, some of them were incepted in October of 2022. And the active equity models just got their 1-year birthday. Just a plug for Ascend, our 3-year birthday session that Kara mentioned is us going to talk through what we're calling a portfolio playbook and different ways to think about how you can combine or choose an appropriate model from this based on specific client situations. And our longer term goal is to actually produce a flip book with a lot more scenarios. We're going to talk about 4 or 5 in that session, but we're producing materials that we want to help you to navigate this. In my prior firm, we did a lot of behavioral research, and one of the challenges of 55 models is the paradox of choice concept, which means the more choice we give you, the harder it is to navigate. So we're doing everything in our power to make these more easy for you to navigate. And of course, you can always reach out to the specialist team or to us directly in the PM team, and we can get you information and answers if you ever have any questions on what model might be appropriate for a specific client situation. I always talk about the benchmark, and I have a slide farther in here that I'll share with you. We try to keep our benchmark really simple. Brian, if we can just stay on that page for a sec. One of the things that, we get criticized a lot is, oh, you've had a bit of a hard time beating your benchmark since inception. Well, we feel like we've created a simple benchmark, but one that is harder to beat than what we've seen a lot of our competitors come up with. And so we simply take the MSCI USA and the MSCI ACWI. We combine them at a 30% weight to US and 70% weight to ACWI, which gives us currently about 76.5% in the US. That reflects what we think is a fair home bias, yet still stays true to ultimately the fact that diversification works over the long run. And an interesting tidbit is when we launched just two years and 9 months ago, that US number was 70%. So as the US has outperformed, just even in less than 3 years, US has become 6.5% larger in our benchmark over this period. Developed international at 19% is down a couple percent, and EM at 4.5% is down about 1% from when we launched. So our benchmark is dynamic. It moves as things sort of outperform and underperform over time. And then in fixed income, we use the US Universal, which includes more credit and some high yield, which, as you probably know, has significantly outperformed just the broad investment grade bond market. And, the Barclays aggregate has underperformed our benchmark during this period. We have no intention of changing this. We still have full intention of outperforming these benchmarks, and we have been mostly competitive with them and really competitive with the universal model managers. So if we go to just performance on the next slide, on the left-hand side is these components of our different benchmarks for our different models, for the quarter on the left and for the full year on the right. And a couple of things that stand out to me is US stocks were really the only stock market that went up. Global stocks were down 1%, but again, that's a heavy weight in that global benchmark to the US. If I look at EFA and EM, they were down significantly more than US bonds. They were down in the neighborhood of 7 to 8% for EM and developed. What's not on here is the US dollar. Depending on what index you look at, the US dollar was up either 7.5% or 9%, depending on how you basket the currencies. So almost all of the downside return in international for the quarter was driven by the dollar. And there's a lot of debate on, a lot of people think the dollar will remain strong. While we do look at currencies, we tend not to have them be a huge input in our shorter term decisions in the models as we think about how we should be positioned. The other thing is just large growth versus large value. So in the quarter, you see growth up 7.1 and value down 2%. So a 9% divergence. That's actually, since the beginning of 2023, the third best outperformance of growth versus value. And in there's 8 quarters. In 6 of those quarters, growth beat value. And they did it by a cumulative 60% over the last 2 years. And for just the full year, right, a large growth up 33.4, large value up 14.4, almost a 20% outperformance of growth. So some of the things when I talk about the backward-looking attribution is if you weren't overweight growth or even market weight growth, which we think even market weight growth was a pretty big absolute bet, you really had to have super good selection in the other parts of your portfolio to outperform. And then the other thing that was interesting to me, Ryan, if you flip to the next page, these are the benchmark performance for our asset allocation models. Again, quarter on the left, year on the right. And what you'll see is the majority of the benchmarks had negative returns in the quarter. But what was really a big impact, which is not usually the case, because usually stocks have much bigger returns or more volatile, different returns than bonds. What we saw was muni bonds meaningfully outperformed taxable bonds. So the tax-aware benchmarks were a little bit harder to beat relative to the taxable benchmarks. But for the full year, they ended up pretty close together. In fact, the taxable benchmarks so the IUSB or our Barclays US Universal did beat munis for the full year, but definitely struggled in the fourth quarter. And then just the magnitude of all these asset allocation portfolios, mostly ranging and I'll show you a slide where most of your money is 60-40 and above, everything was double digits for the benchmark, which was really a pleasing performance for probably all your clients and everyone's business. On the next slide, what I wanted to show you is sort of the breadth of our models and how they perform on an absolute and relative basis. So again, keeping fourth quarter on the left-hand side and full year on the right-hand side. Again, a lot of negative returns in the quarter. So out of our 55 models that had a return for the full quarter, only 4 had positive returns, but on a relative basis, more than half, or 51% of our models, outperformed their benchmarks. And for the full year, factor tilt wasn't available for the full year, so we only have 48 models that had a full year history. 73% or 35 of those models were able to beat their benchmarks in a year similar to 2023, where we think it was very difficult to beat the benchmarks that we measure ourselves against. On the next slide, I wanted to simplify this. So last quarter, I showed you all our models, and I think Kara fell asleep or her eyes went cross-eyed when she looked at it. So she encouraged me to simplify it a little bit. So I just took the dynamic and strategic models and their tax-aware iterations to show you the absolute performance. And you can see, compared to the prior slide on the left-hand side, most of these returns are down, but they're very similar to what the benchmarks performed. Our correlations and our betas are very tight to the benchmarks. Our active risk budget is at 3% in terms of a tracking error. Our tracking error for the quarter, we were taking a little less than half of that risk. So the majority of the models had a lower than 1.5% tracking error for the period. And the dynamic tax-aware models performed the best. And that is because they do have the most large cap growth-oriented exposure in those models. And again, tax-aware models obviously had better absolute performance on the fixed income side. On the next page is the full year for just absolute performance. And again, what was really impressive was the absolute numbers for essentially 40, 60 and above. You are 10% or higher for the majority of the models, which is where the majority of the assets are across the distribution of our models. If you want to talk relative, I have that in the appendix, but I wanted to skip that for now to talk about a few other things. So on the next slide, I wanted to just share active equity. We're super excited about this product. I mean, not only is L2, the firm that we work with on this product, just great people to work with, we really believe that the way they approach investing is one that will lead to exceptional results over time. So a couple points that I wanted to make on this is if you look across all four strategies for the full year, they all had double-digit returns and they all meaningfully outperformed their benchmarks. They did so, however, within the risk controls that we set for these portfolios. And two of those key controls are no more than 10% overweight or underweight any sector, which is somewhat difficult to do when you're only dealing with a 30 to 40 stock portfolio, and then a 10% or less tracking error. And mid-cap had the highest tracking error, but it was still only about 8.5%. And a lot of that was driven by SMCI's performance early in the year. So we're super excited about that. And one other point was you can buy large cap core and large cap growth and expect different behavior. Unlike if you brought the Russell 1000 ETF and the Russell 1000 growth ETF, because there's 100% overlap in the securities in Russell 1 growth that are also in Russell 1000. The most number of stocks that any two models have held at one point in time is 5. So we are trying to explicitly hold different stocks in these portfolios, and the different sort of overlays for how they do portfolio construction on these models led to both great returns and outperformance and non-overlapping holdings. So that's active equity. Couple of thoughts on the next slide is how did we do versus peers? So it's funny, we sometimes get questions of, oh, hey, I use this provider for a strategist and they beat their benchmark. Why didn't you guys beat your benchmark? Well, we say, what's their benchmark and what's their absolute return? And whether it's during the quarter last year, the last 2 years, and even back to inception for dynamic and strategic, we've generally found that we've been able to outperform the Morningstar peer averages and the peer medians over this period. The other thing that you'd want to notice is that we tend to cluster slightly above the average. There's a few outliers in here, so we try not to be the best or worst performing manager in any given period, because those strategies get there by taking very big risks relative to their benchmark. And one other thing we don't do is underweight or overweight equities by more than 5% in our category relative to our benchmark. And we think that risk control will never have you the best, but more importantly, it will never have you the worst, which is the biggest thing we're trying to avoid in these models. So this is the picture of the absolute returns. You can see how much we've done better than the averages. But on the next page,
Hey, Derek, before you move on, I just want to like give you and the portfolio management team kudos here. And you know, you're naturally a very humble person. So I just want to highlight the fact that, I mean, we had 4 stock picking strategies, all of which outperformed the benchmark and way outperformed peers. I mean, like mid-cap outperformed by 1,100 basis points. That is remarkable. And this will not happen every year, but I think this shows like the strength of the process that the portfolio managers use in identifying opportunities. And this is very, very rare. Last year was an extraordinarily difficult year to beat the benchmark. When you only have 7 names that are driving the return, it's really hard to pick stocks that are going to outperform the benchmark. And then to have, if you look at strategic and dynamic and some of our other strategies, over a 2-year period, every single one of those strategies has beaten the peer group. Again, I mean, that is a really remarkable, and like kudos to Derek and team for being able to do that while taking a very risk-aware approach.
And I'm glad that Pedlo's probably not listening, but the active equity so far year to date, all 4 strategies are outperforming. But you're right, like
there we go.
Temper our expectations that they're not going to do it every quarter, every year. But you know, we expect that process to be a very durable one that will lead to good results over long periods of time. For those of you that have clients that want to hold individual stocks and have some active management, which we think is crucial given how concentrated just the overall market's become. So if we flip forward 2 slides, I wanted to just show this one more, Ryan. One more slide. So here we just put it in percentile rankings to Kara's point. So one model for the quarter, active income underperformed the average. And the big reason for that, active income to get yield has the most small mid exposure except for factor tilt, but also the highest international exposure. As international has underperformed the US, the yields in equities in international are just significantly attractive. And so we do have a little bit higher weight there. Despite that, even though growth outperformed the last 2 years, every one of these models is in the top quartile for last year and in the top quintile for the 2-year period. So we're pretty proud of the fact these rankings, and again, on any given quarter, we're not always going to outperform our peers and benchmarks, but this is our goal. And we're proud that we've been able to at least deliver on this so far since we've launched these models. And all these different series that are trying to solve different client needs. You know, you might expect them to be more dispersion across the models, but we've been able to deliver them despite whatever the model's constraints or preferences are tied to that model. So that's what I wanted to talk about on performance. Next slide is, let's just look backwards. And this is always hard for me because every day I come into the office, I think about what's the most important day investing. It's tomorrow. So I'm constantly thinking about tomorrow, and the team is doing the same. So we'll go back and review some of the things that helped. But what's more important, what I'll close with, is how we're positioned today from a general standpoint. Dynamic 60/40 on a relative basis was our most challenging model for the full year. But again, its rankings was still really good relative to the peer group because our benchmark is tough to beat. The positive side of things was our equity overweight of an average of about 3% through the year. Now we changed it from 2% to 3% and to 4%. So it wasn't static throughout the year, but as the market had its ups and downs, being overweight equities that whole period was big. Stocks beat bonds by almost 1,800 basis points. So that US equity allocation, or the US equity overweight allocation, was the biggest contribution. We call that allocation effect. For selections, now this gets a little tricky. We say emerging markets, international value were positive contributors. The way we're looking at that is relative to the international markets in general. EM and international value outperformed the broad international market. They certainly did not outperform the US, but by having those in the portfolio for the full year relative to the benchmarks positions, that was a help for us. And then obviously US growth and tech were the biggest contributors. Fixed income was interesting. We actually tended to do better in fixed income this year. And earlier in the year, we had a much shorter duration when the curve was inverted. So things like AAA CLOs, which is, people ask a lot about private credit. This is a form of private credit. And floating rate bonds were positives. And then, of course, detractors included value, quality, international growth, and small and mid cap. On the strategic portfolio, we had a slightly less overweight, but it was a positive contributor. And then some of the positive positions on equities were momentum and US growth. And in fixed income, the high yield exposure, investment grade corporate bonds were positives. And then as we extended duration later in the year, that was a little bit of a negative. So that's kind of what happened last year. On the next slide, there's 2 slides I just want to cover quickly. This, if you think about our portfolios in the equity space on the Morningstar style box, upper right is large growth, lower left is small value. You can get a sense of dynamic tax aware being the most large cap and growth exposed, and factor tilt obviously being tilted towards those small and value factors. The next slide I'll skip over.
Actually, Derek, if you don't mind, I just want to, I know we're, we only have a few minutes left, but I do think the previous slide is worth just highlighting again. We've been talking about this for a while, but it's not intuitive. when we look at our equity benchmark, so think S&P 500, Russell 1000, it's a similar story. When you think about a core benchmark, because these large growth names have done so well over the last 2 years, they've become a disproportionately large part of a core benchmark, such that a core benchmark today looks a lot more like a growth benchmark a couple of years ago. So it's something to keep in mind as you're putting together your portfolios. The core benchmarks are not giving the level of diversification that we have come to rely on them for. And so again, you might want that growth exposure, but if you want something that's a little bit more balanced between value and growth, you got to work a little harder for it. And it's something, if you want to reach out, we're happy to sort of think about portfolio construction, but we wanted to highlight how these different styles will get you into a very different place from a style perspective. But your starting point in a core benchmark is pretty off of center today. So sorry, Derek, I just wanted to highlight that.
And I appreciate that comment, Kara, because Alan, and again, another plug for Ascend. One of the things we're going to show is where the Mag 7 falls on this. And it's
yes, way up into the right.
It's outside of this scale because it goes farther right and farther north, which is crazy. On the next slide is just the progression of US versus international. So let's skip over this one. And just let me close with how we're positioned today, which is essentially we're 4% overweight. We considered going max overweight given some of the positive characteristics at the end of the year. But given valuations on the US equity side, we have that moderated a little bit, and we're very diversified. We do underweight in pretty much all portfolio, even Dynamic Tax Aware is slightly underweight large caps, but that is the one that looks most like the benchmark on the equity side right now. Whereas Active Income and Factor Tilt also overweight equities, but tilted more towards the cheaper stocks in the market. We did make a bad trade in REITs in the fourth quarter, but we reacted quickly and removed that, and that's been a positive since we removed REITs. All the models are overweight small and mid. The biggest thing is fixed income. So we've been, as the curve was inverted, we've been perennially short duration. As the curve now has an upward slope to it from 3 months out to 10 years, we have extended duration. We haven't done it with government bonds, though. We've done it with high quality corporate bonds, and that hurt us a little bit towards the end of the year, but I feel like it's positioned us really well. And I want to close with just one comment I heard on a Jim Bianco research call lately. The last 3-year bond performance, looking at the 10-year treasury, was the worst, the 3-year performance, the worst in 180 years. I don't have the data back that far. Bianco does. That's why we use them for research. In order for you to repeat that performance, the 10-year treasury needs to go from 5% today to approximately 18% to get that same amount of absolute negative return. In other words, when you're thinking about bonds, don't think so much about how they've done recently. Think about the current income they're generating and the fact that while correlation is positive right now, it's still low and it still provides diversification. So sorry, I'll stop there. Kara's yelled at me 4 times to stop. So I apologize.
Okay, luckily everybody on this call knows that I'm not yelling at you.
Yelling at me in all caps in Teams.
So we do have a couple of questions and we have just a couple minutes left. Derek, this one is to you. We're evaluating Kim with some other managers we use and trying to understand what's causing the standard deviation of a 70-30 portfolio to be about 2% higher with Kim than with the other manager. And performance was about 2% higher, so Sharpe about the same. So he's just trying to understand the dynamic.
Yeah, so I'm not sure who the other manager is, but let's just assume they're strategic and that they're holding the benchmark weight at 70-30. Because we've been perennially overweight equities for the full year in both our strategic and dynamic models, again, by between 2 and 4%, so not huge, that obviously will start to lead towards a little bit higher overall volatility. The reason we're okay with that, as Kara mentioned, is equity volatility has been well below average for a while. And generally speaking, while there is some risks to worry about in low vol environments, generally speaking, risk asset stocks do really well when vol is low. So on a relative basis, we've been taking more vol. Hence the Sharpe ratio kind of looks bad. I have really strong feelings on Sharpe ratio and no disrespect to anyone who uses it. I understand it. It's an industry standard. I worked at a firm that built models based only on their historical Sharpe ratio. When was the last time a client asked you about their Sharpe ratio when they did their statement? In my mind, yes, it's a risk measure, risk adjusted return measure that we're aware of. But at the end of the day, we want to be risk aware, but generate the best possible returns for you all. And again, I look at that relative vol every single day. And you're right, it's depending on the period, it's been about 50 basis points to 200 basis points higher over every sub period. But we're comfortable with that because we feel like it's a good time to take that risk. You see it in higher vol, like it's a trade-off. But I don't know. And let me just close with one thing. Sorry, Kara. The Sharpe ratio for the Bloomberg aggregate bond over the last 35 years is 0.48. For the S&P 500, it's 0.34. Does that mean you should own the ag? No, because you would have underperformed by such a meaningful amount. So it's a useful stat, but I fear it's misused sometimes in selection of models. It's informative, but be careful how you think about it in that context. If our standard of deed was 5% higher, you should fire us. That's what I would say.
Todd, aren't you glad you asked about Sharpe ratio? That's only a snippet of what Derek really wants to talk about.
Todd, I hope I didn't offend you because that wasn't my intention.
No, actually, I hope you guys know that we love talking about this stuff. So what I was going to suggest is that if you're interested, please send over the portfolios, and we're happy to do a deep dive side by side. It's hard to talk intelligently about it, not knowing what the other portfolio has, but we're happy to do that. It might be something obvious like our overweight to equities, but it might be some other position that's driving that difference in risk. And happy to just hop on the phone too and talk about it directly. There's one other quick question in the chat, which is relative return the amount in excess of the benchmark? So Derek, just maybe give the definition of relative return.
Oh, I wish it was always the amount in excess of the benchmark, but it is the amount either in excess or below the benchmark. So some periods it's underperforming, but yes, the short answer is it is either the outperformance or the underperformance.
Great. And Derek, just so you know, Todd said he loved your answer. So
Todd's way too nice to me.
So just know that, as I said earlier, these materials are available. The market outlook section is client approved. The stuff with the model performance is advisor approved. And, like I mentioned, if you want to dig into anything in more detail, please just give us a shout. And Happy New Year. I'll say it one more time.
Thank you, everyone. Happy New Year.
Take care.